Most people think the richest companies in the world make money by selling products. Apple sells iPhones. Coca-Cola sells drinks. Amazon sells, well, almost everything. But one of the most powerful companies on earth barely sells anything you can touch. It doesn't manufacture cars. It doesn't build houses. It doesn't own oil fields. Yet it manages more money than the economies of almost every country on the planet. Today, that number is over $11 trillion. That's trillion with a T. If BlackRock were a country, it would rank among the largest economies in the world. So here's the question. How does a company managing trillions of dollars actually make money? Does BlackRock invest its own fortune? Does it secretly own every company? Or is there a much simpler business hiding behind one of the most complicated financial empires ever created? The answer is far more fascinating than most people realize. Because BlackRock didn't become the world's largest investment company by gambling with money. It became one by charging millions of people tiny amounts that almost nobody notices. And those tiny amounts have created one of the greatest money-making machines in history. To understand how, we need to go back to 1988. The financial world looked very different. Wall Street was dominated by giant investment banks. Computers were slow. Data was limited. Risk management was primitive compared to today's standards. That year, Larry Fink and 7 partners launched a small investment management company with one big idea. Most firms focused on making investments. Larry Fink focused on understanding risk. The idea came from experience. Earlier in his career, he had lost roughly $100 million for his employer after interest rates moved unexpectedly. That painful mistake changed how he thought forever. Instead of asking, how much money can we make? He started asking, what could go wrong? That question would eventually reshape the entire investment industry. BlackRock started as a bond management firm. Its early clients weren't ordinary investors. They were pension funds, insurance companies, banks, and governments, organizations responsible for managing billions of dollars. These institutions had one major problem. They couldn't afford catastrophic mistakes. So they hired BlackRock to protect and grow their wealth. At first glance, it sounds simple. Someone gives BlackRock money. BlackRock invests it. Everyone wins. But here's the twist. Most of that money never belongs to BlackRock. That's one of the biggest misconceptions people have. BlackRock doesn't own $11 trillion. Its clients do. BlackRock simply manages those assets on their behalf. Think of it like a luxury parking garage. The garage doesn't own the Ferraris parked inside. It charges owners to keep them safe. BlackRock operates on a similar principle. Instead of luxury cars, it safeguards investment portfolios worth millions or even billions of dollars. And that's where the first revenue stream begins, management fees. Imagine someone asks you to manage $100 million. You agree to charge 0.5% each year. 0.5% sounds tiny. But 0.5% of $100 million equals $500,000 annually. Now imagine thousands of clients, then tens of thousands, then millions of investors around the world. Suddenly, tiny percentages become enormous amounts of money. Scale changes everything. Today, BlackRock earns billions of dollars every year primarily through management fees. Not because its fees are high, because the amount of money under management is enormous. And this creates a remarkable business model. Whether markets rise or fall in the short term, investors still pay fees as long as their money remains invested. When markets grow over many years, BlackRock benefits even more because the value of client assets increases. Higher assets, higher fees, without charging a higher percentage. It's one of the most scalable business models ever created. But management fees are only part of the story. The real explosion came from something almost every investor has heard of. ETFs, exchange-traded funds. Before ETFs became popular, many investors bought actively managed mutual funds. These funds employed teams of analysts trying to beat the market. The problem, they charged relatively high fees, and many failed to outperform simple market indexes over long periods. investors began asking an uncomfortable question. If beating the market is so difficult, why not simply own the market? That simple question changed investing forever. BlackRock already had the perfect answer. Its iShares division. iShares is one of the largest ETF businesses in the world. An ETF can hold hundreds or even thousands of stocks. Instead of choosing one company, investors buy an entire basket with a single trade, want exposure to the 500 largest American companies. There is an ETF for that: technology, healthcare, emerging markets, clean energy, government bonds. There are ETFs covering almost every corner of global finance. Millions of investors use them because they're simple, diversified, and relatively inexpensive. Now, here's where BlackRock's genius becomes obvious. Each ETF charges only a very small annual fee, sometimes only a few hundredths of 1%. That seems almost free. But when trillions of dollars flow into those ETFs, tiny fees become billions in annual revenue. It's the classic power of volume: earn a little from everyone instead of a lot from a few. This strategy transformed BlackRock into the dominant force in passive investing. Yet, there is another business hidden beneath the surface, one that most ordinary investors have never heard of. It's called Aladdin. The name sounds like something from a movie, but inside finance, Aladdin is legendary. Aladdin isn't an investment fund. It's software, sophisticated software. Imagine trying to monitor millions of investments spread across every country, currency, industry, and bond market simultaneously. Human beings can't process that amount of information fast enough. Aladdin can. It analyzes portfolios, measures risk, runs stress tests, and helps institutions understand what could happen if markets suddenly change. Banks use it, insurance companies use it, pension funds use it, asset managers use it. Even organizations that compete with BlackRock rely on Aladdin. That's because managing risk has become just as valuable as managing money. Software subscriptions create another dependable source of revenue. Unlike investment performance, software income tends to be more predictable. It diversifies BlackRock's business even further. Now consider another interesting detail. People often say BlackRock owns everything. That's not exactly true. BlackRock manages shares in thousands of companies because its clients invest through index funds and ETFs. When millions of people buy an S&P 500 ETF, BlackRock purchases the underlying stocks on behalf of those investors. Legally and economically, those investments belong to the fund's shareholders. BlackRock acts as the manager, not the personal owner. That distinction matters because it's easy to confuse managing assets with personally owning them. Still, the sheer size of BlackRock means it often becomes one of the largest shareholders in many public companies. That naturally raises questions about influence. Every year, companies hold shareholder meetings. Important decisions are made. Board members are elected. Executive compensation is approved. Major corporate proposals are voted on. Because BlackRock represents millions of investors, it participates in many of these votes. This has made the company one of the most influential voices in corporate governance. Supporters argue that BlackRock encourages better long-term management and accountability. Critics worry that too much influence is concentrated in the hands of a few giant asset managers. The debate continues regardless of where someone stands. One fact is undeniable. Influence has become another competitive advantage. Large institutions want experienced managers. Experience attracts more assets. More assets increase influence. Influence attracts even more clients. It's a self-reinforcing cycle. But this business isn't risk-free. During major market crashes, the value of client portfolios falls. Since management fees are often based on assets under management, revenue can decline as well. Clients may also withdraw money. Competition remains fierce. Companies like Vanguard, State Street, Fidelity, and others constantly compete for investors. Fee pressure has become relentless. Many ETFs today charge incredibly low fees because firms are fighting for market share. Winning often depends on scale. Fortunately for BlackRock, scale is exactly what it has. Consider what happened during the global financial crisis in 2008. Markets collapsed, fear spread everywhere. Yet BlackRock's expertise in risk management became even more valuable. Governments and financial institutions sought help analyzing troubled assets. The crisis strengthened BlackRock's reputation rather than destroying it. Years later, during the COVID-19 market turmoil, governments once again turned to experienced asset managers as financial markets faced extraordinary stress. Moments of uncertainty often highlight the importance of firms that specialize in managing risk. Another reason BlackRock keeps growing is surprisingly simple. The world keeps saving money. Workers contribute to retirement accounts. Employers fund pension plans. Governments build sovereign wealth funds. Insurance companies collect premiums. Universities manage endowments. All of that capital needs professional management. BlackRock doesn't have to convince every individual investor personally. It often serves the institutions already responsible for managing millions of people's savings. That's a massive advantage. Now think about the numbers. Suppose a new investor contributes just $100 into an ETF every month. It seems insignificant. But multiply that by millions of investors across dozens of countries, month after month, year after year. The flow becomes enormous. Those steady inflows help explain why asset managers continue growing over decades. The secret isn't one spectacular investment, it's consistency. So how much money does BlackRock actually make? The exact figures change from year to year, but annual revenue is measured in tens of billions of dollars, while net income reaches several billion dollars after expenses. Those profits come from multiple sources working together: management fees, technology services, advisory, businesses, institutional investment solutions, risk management software. Each business reinforces the others. That's what makes BlackRock difficult to compete against. Many companies have great products. Few have an ecosystem this powerful, and perhaps that's the biggest lesson of all. BlackRock didn't become the world's largest asset manager because it consistently predicted which stock would soar next. It built a business around something far more dependable: helping other people invest. Instead of betting everything on market predictions, BlackRock created systems, technology, and investment products that millions of people use regardless of whether markets are rising or falling. In the end, BlackRock's greatest asset isn't the trillions of dollars it manages. Those assets belong to its clients. Its greatest asset is trust. The trust that governments, pension funds, institutions, and everyday investors place in a company to manage their financial future. And in the world of finance, trust may be the most valuable investment of all.